Hey guys, um, this video is the second part of Andrew Mellon and his tax plan. What I'm going to do, I'm going to show you some charts. This all has to do with Andrew Mellon and his tax plans. And if you remember from the video, his plan was to cut taxes for just regular people so that they could have more money. They could keep more of the money that they earned. And I'm going to go through some charts that help demonstrate that a little bit. And there's going to be three charts: one from 1921, one from 1924, and one from 1926. And this all has to do with how those taxes get lower and lower. And again, that's all part of Andrew Mellon's plan. But this is all about just continuing the skill of how to read number charts, how to interpret them, and what they mean. So this is a chart for the Revenue Act of 1921. Revenue is just kind of another word for money, but basically this chart is showing how taxes for regular Americans are getting lower. So what I want to do, so in this chart you have this thing called net income. That's the first column, and it goes down. Net kind of means like total, and your income is the amount of money that you earn in a year. That's what income is. It's the amount of money that you earn in a year. You don't have to worry about these two columns because they get into more complicated stuff. But I'm only going to focus on this column called the combined rate in the percent. Combined rate, that just means the actual tax percent for each. It's going to be for each American depending on how much money they make, and I'll explain that more. So let's kind of look at this for a little bit. So let's say, for example, let's say somebody in 1921, let's say they make $4,000 in a year. Now that doesn't seem like much today, but back then $4,000 was a pretty good amount of money to work. It wasn't a lot of money, but it was a decent amount. So somebody earned $4,000. That was their net income, or their total amount of money that they earned in a year. Okay, so don't worry about this column and don't worry about this column, but just worry about this column. So if somebody made $4,000 in a year, they would be taxed 8%. So that's all that means. They'd be taxed 8%. It may not sound like a lot, but it is. All right. And we're going to look at each one of these charts, this one, and see how that percentage changes. So again, this is from 1921, and this one is 3 years later. This is 1924. And let's look at, again, the net income, or the total amount of money somebody earns in a year, is $4,000. Look, and don't worry about this column, don't worry about this column, but see how the tax rate lowered. This is 4%. In 1921, it was 8%. And in 1924, it went to 4%. So their tax was cut in half, or it was lowered by half. What's half of 8? 4. So you take 4 away from 8, you get 4. So that is just showing the idea that people are now getting to keep more of their money because their taxes are being lowered. So that's 1924. Let's jump ahead to another chart that's in 1926. You go $4,000, total amount of money that somebody earned, or the net income in 1926. Don't worry about this chart. Don't worry about this chart. Just look at this one. Is the tax rate getting lower? Sure it is. It's now down to 3%. So somebody who made $4,000 in 1921 would be taxed 8%. Somebody who made $4,000 in a year in 1924 would now be taxed 4%. And in 1926, somebody who earned $4,000 would be taxed 3%. So that's just showing you is that people are having their taxes lowered and they can keep more of their money. And that's just kind of how to read this chart and what it means. But I do want to show you one other thing. Back then, some people could earn a lot of money. Some people could earn $1 million. So let's look at $1 million. So if somebody made $1 million in the 1920s, or I'm sorry, before in 1921, they would be taxed 73%. That is a huge tax percentage. They would have to pay a lot of their hard-earned money, or pay a lot of their hard-earned money back to the government. And people like Andrew Mellon just didn't think, that's not a good thing, because we want people to keep more of their money so they can spend for other businesses, or perhaps put it back in their own business. If you think of a person who earns $1 million in a year, what kind of, just pause the video and take a second. What kind of person earns $1 million in a year? Do you think it's somebody who works at a restaurant? Probably not. Do you think it's somebody that owns a small business? Maybe not. They probably wouldn't earn $1 million in a year for a small business back in 1921. The kind of people who make $1 million back in 1921, those are probably like owners of like really big corporations or really big businesses. This might be somebody like an Andrew Carnegie or a John D. Rockefeller. Maybe somebody like that. Somebody who earns $1 million in 1921 is probably somebody like that. And they would be taxed 73%. And, somebody who makes, $4,000, those are probably guys who, maybe maybe they deliver the mail, or maybe they work at a restaurant or something like that. They're not business owners. They're not really powerful people. So you can probably just imagine the people who earn certain amounts of money. You could probably make a guess at what kind of job they might have. All right. So somebody who earns $100 million, they'd be taxed 73% in 1921. In 1924, well, this doesn't say, but just to give you a reference, if somebody makes $500,000, they get taxed 40. Well, actually, let me just go back to the first chart. If somebody makes $500,000, they were taxed 72%. In 1924, if they made $500,000, they would be taxed 46%. So it went from 72 to 46, and in 1926, well, this doesn't say it either. But the point is, if you just look at this example, their tax rates are getting a lot lower. 72% to 46%. They are saving a lot of money, and they can do whatever they want that money. They can put it back in their business, or they could pay their workers more if they wanted to, or they could spend it on other businesses. And that was all Andrew Mellon's that was all part of his plan to lower those tax rates and get more people or more money into the pockets of many people. All right, I'm going to stop the video right there, and I'll pick it up with one more video.